Good. Now, my next guest, he has said all along throughout all of this that bull markets deserve the benefit of the doubt, that this one still does. I want to bring in now Truist Wealth CIO, also Chief Market Strategist, Keith Lerner. All right, Keith, so you wrote yesterday that the bull market still deserves the benefit of the doubt here. Why? Why were you telling your clients that? Because obviously a lot of people are on the ledge right now.
Yeah, well, first, great to be with you. Nice to see some green on the board again after yesterday.
Yeah.
And that has been our slogan for the last several years during this bull market. Bull markets don't move in a straight line, but this one has proven itself over and over again. And let's look about the last 5 years. These corporations have been battle tested through COVID, through fast rate hikes, through inflation. And on the other side of that, we're seeing profit margins at an all-time high and earnings at an all-time high. And that's why we still think the bull market deserves the benefit of the doubt.
And I love that point, right? The supply chain, you make adjustments, you do better. Fed's not on your side, you make adjustments, you do better. And of course, you've talked about the carousel of concerns, and it continues again. Here they are. The tariff pause, down 19% last year, started the same way on their tidal wave of fear anxiety, but we sprung back pretty nicely.
That's right. And we kind of have this tagline that we've been using for several years, the carousel of concerns. And what happens today, we're talking about Iran. 6 months, we'll be talking about something else. So as one concern recedes, another pops up. What we really focus on is our weight of the evidence approach. We're looking at the economy. We're looking at history as a guide. We're looking at fundamentals and technicals. We put that together today. We might have a little bit more of a give and take here. But again, when we look at the earnings, which are at a new all-time high, right, it suggests that you should look through some of these concerns unless it's going to have a major impact on the earnings side, which we don't see as of yet.
So you see on the back, ultimately, still 2%, at least 2.2% GDP. We've got the concerns. We've talked about them. We've got the other things that we've been concerned about. But here on the down, on the green side, the tax incentives, tech capex, we know data center spending is out of this world. Wage gains are starting to come on. Lower oil independence, important, has already helped us weather this. So I want to talk about to get this where some opportunities may be out there. So you like materials and industrials, right? This is where we are year to date on the S&P. We know energy is an anomaly.
Yep.
But you think materials and industrials continue to power ahead?
Sure. In fact, our overweights right now are materials, industrials, energy, and tech. But on this side, on the industrial side, that's made up of transportation and defense. Now, defense spending isn't likely going down; it's likely going up.
Yeah.
And
they only asked for 1.5 trillion. So.
That's it. So, and that's a secular trend that we expect to continue. And on the other side, the transportation names, if the economy kind of stays resilient, which is our base case, we should see more upside there as well. On the material side, there is a little bit of an AI build out that happens there, but also think about the rebuild of what's happening because of supply constraints, underinvestment over the last decade and so forth.
Right. Also on technology, we want to bring this up because you say technology, AI-related spending. We know that's a key economic support. Listen, the trillions of dollars pours into this economy. I guess the question is, does that mean, and I think you've already kind of answered this, the viewers or investors, should they have outside exposure to this as well in their portfolio?
Yeah, we still have an overweight towards tech. As you mentioned earlier, and I thought it was a really good point, there is a big divergence. Like, I agree with you. Software stocks are making relative lows. We don't like following relative lows. On the other side, semiconductors are making new highs. The demand for semiconductors isn't going away, and that's where the earnings strength is. So we would stick with that within the technology side. But we still like technology, especially after the valuations have come down from a 32 forward PE to 20 at the recent low. That's a 35% contraction in a couple of months.
Right. And you don't hear the AI bubble or Mag 7 bubble talk too much anymore, do you?
No, I thought that was overdone too. Listen, I worked and I started my career in the mid-90s, and you and I both know what a technology bubble feels like and looks like from a price perspective. That's not it. I think at least now we're seeing valuations that are at least more reasonable and expectations have been reset. So I think we're in a good spot for tech.
The first tell is that no one back then was calling it a bubble, right? If everyone says it's a bubble, it's not a bubble.
Yeah. Well, too, back in the 90s, people were leaving their jobs to be day traders. We're not seeing that today.
Listen, I couldn't get in a cab without someone trading at the red light. I couldn't go into a bar or restaurant without them talking about the markets. And everyone was going to retire at 40 and buy their own island. I remember it. No one's talking like that right now, which is maybe a buy signal. Keeps great stuff, by the way. It takes us so long to go through all of your reports to figure out what to use because it's that great. Thank you.
I appreciate it. Thanks so much.
Appreciate it.